Hello, good morning, students.
Good morning, Jeff.
Start the discussion or yet we screen is visible, right? The PPT slide is visible.
Yes, sir.
Okay. The first internal IA test schedule is been circulated in the group. Okay. Even in the mergers group is also circulated. Kindly circulate among the other groups so that you
Yes.
people will come to know about the first IA test. Right. So shall we start the discussion? So So today we'll start with a new topic called as a Black's valuation of options, right? So we have been discussed about like a forward valuation. So how to value the forward contract, right? So we are trying to see like that helps us to know the intrinsic value of the contract, and that in turn helps to make the decisions, right? So the decisions that usually the investors make is the buy or the sell decisions, right? So to make the buy decision or to make the sell decision or to take a short sale decision, right? So investor wants to know whether the underlying asset in a coming days in the future will be an undervalued or it would be an overvalued, right? So to know the undervaluation or the overvaluation or in general about the valuation of in the stock or in an asset, right? So we have to apply the valuation model. Coming to the option market, as I said, like there is a quite different with respect to the variable that we take for the valuation here, right? So in the case of like in options, we take the variable as the option price, that is the premium what we pay to buy the asset, that is the call buyer and the put buyer who pays the premium, right? So premium would be the valuation which has to be made, and this is the premium which is going to be traded into the market. That is, if you want to buy the option market, that is a call or a put, right? It is not the strike price or the excess price, right? It is a premium what you pay to buy or sell. It is what it is going to be traded into the market. Okay, so this is about like an options. Fine. So with this, so we'll try to know what are the different types of valuation models, right? So the different types of valuation models that we come across here are, one is the Black-Scholes model, other is the put call parity, other is the binomial model. So out of these three, the Black-Scholes model is quite very popular and famous model that we come across in the valuation, followed by the put call parity, which helps to know the price of a one option price when the other option price is been known, right? If we know the call, it will help to know the put. put, if you can easily know about the call, and also for the arbitrage process in the put call parity, right? For the arbitrage process in the options, put call parity is very useful. Then comes the binomial model. It's not so popular as we have like in a Black-Scholes model, right? So even binomial model will also helps us in terms of knowing the price of the option price. Okay, so with this, let's start with the Black-Scholes model and try to understand it, like how exactly the Black-Scholes model can be used to know the price of the asset. Let it be the price of the asset for the call option, or it can be to be known for in a put option. Okay, so coming to the assumptions of the Black-Scholes model, right? So here sometimes the possibly there would be a question that comes into the picture about try to know the assumptions of a Black-Scholes model, right? So the assumptions of the Black-Scholes model will also a very important concept, right? And the two things that we come across theoretically from the Black-Scholes model, one is the assumptions of the Black-Scholes model. The other thing is the variables that we come across in the Black-Scholes models. Variables is nothing but various kinds of inputs that is been required to calculate the Black-Scholes model. Let's try to understand about the Black-Scholes model assumptions, right? The first assumption of the Black-Scholes model, what it says here is the option that is being valued is a European option, right? As we discussed about like two types of option, that is an American option and a European option. So European options are those options which can be accessed only on the date of expiry, right? Suppose we have an option that is for an index which is having an American option. The American option is one which can be accessed on or before the date of expiry. It means like let's say today is at 20th, right? So it is, you can execute even on 20th rather waiting till the last Thursday of this month, right? When you say the last Thursday of the month would be the 27th of May would be the expiry if you have been purchased a 1 month contract for the month of May, right? And the expiry of the May contract would be on 27th May, right? Not on the last month, right? 31st is the Monday, but it is going to be expired the last Thursday of the month, right? So that is in the case of like European option. That is, you need to exercise on the date of expiry date, that is on the 27th of the May. That is for European option. That is what the Black-Scholes model is we are using. But in the case of American option, what happens? You can access even on the before, like suppose 20th. You feel like today the price is very attractive and it is in your favor and that you would like to exercise. You can exercise for the case of like American options. But the same thing is not possible in the case of European option. In the case of European option, only on the date of expiry that you can execute the contract. That is the first assumption. And the Black-Scholes model is not applicable for the American options. Okay, that is the first assumption. And the second assumption of the Black-Scholes model is there is no dividend on the stock during the life of the option. What we try to look at, so if there is a dividend payment, right, what we try to do is we'll adjust that dividend payment to the stock if there is a some making that adjusted to the formula. It means when you buy in option market, right, so we don't try to take it the option when you say the dividend as a receivables, right? So when you buy the 3 months option contract for the underlying asset, we don't expect that you are going to receive the dividend, right? If the underlying asset is going to pay the dividend, what is that we'll try to do is in the valuation we'll try to discount it, right? So we'll try to inculcate that the what you say, the cash dividend or the dividend yield into the formula and make it as a normalized formula. So hence it is not going to affect the formula even the company is paying any dividend or it is going to pay in the form of cash or in the yield. It will not be having any effect in the price of the options. That is the second assumption. Coming to the third assumption is there is no transaction cost on the tax, is what the Black-Scholes model says, that there is no capital gain tax, right? If you try to realize the returns within the 1 year, you have a capital gain tax, but the assumptions of the Black-Scholes model says that you will not have the tax and there is no transaction cost. Possibly this is not acceptable, the assumption, because you will have a transaction cost for every transaction that you make, that either you buy or you sell. So you will have the transaction cost here, right? So possibly this may not be acceptable. Then the volatility is known and constant. That the other thing is the volatility that we calculate here is there is a different methodology, that advanced methodology, rather than just using a standard deviation or the beta, right? There are the advanced volatility concepts, what we call as value at risk, which is having high precision and consistency in terms of giving the volatility. And what the assumption says, the volatility remain constant till the date of expiry of the contract. Fine, that is the another assumption of the Black-Scholes model. Then short-term risk-free rate of interest is known and is a constant. Right? The risk-free rate, like a treasury bill, right? So if you say that 365 treasury bills, 90 days treasury bills, 120 treasury bills, right? So we take the treasury bills as a risk-free rate, and which is going to be constant for the time frame which is being given. Let's say 365 days. The treasury bill will not be changing here for the next 365 days, right? The short selling of the stock is permitted, right? Even you can take long on a call, or you can take short on a call, or you can take short sell on the positions, right? So there are two things. Short on a call is different. Short sell on the call is also different. Fine. Call options can be accessed only on the expiry date. This is the option. This is another feature of European option. As I said, like European option only expire on the date of expiry. This is what the assumption says. You can access only on the date of expiry date, right? Expiration date. Right, stock price follow the rule of log normal distribution, right? What they say is the stock price is going to vary. Like the stock price can be volatile in the form, like it can be in the different forms. It can take in the form of like bell shape, it can take, or narrow bell shape it can take. But what they say is that the theory of the Black-Scholes model says, or will always they follow a normal distribution. When you say normal distribution, there is no seasonality in the return, right? So there is always the flow in a random process, not having any seasonal return, right? This is what some of the assumptions of the Black-Scholes model, right? Then let's try to look at more about the variables, right? So list of the variables that are being considered for computing the value of the option. Right? If you want to compute the Black-Scholes model, sometimes what happens is they will not be mentioning to you whether you need to apply the Black-Scholes model or what kind of a model. Looking at the variables, right? What are the variables that has been available for solving the problem? Looking at the variable, right? We need to what you say? We need to identify that this is the Black-Scholes model. Now, what are the variables that have been required to calculate the Black-Scholes model? Right, one of the variable that we require is the current price of the asset, right? What we call as a S naught, which has been denoted, right? The what we call as a stock price. The value of the call exercise call increase as the stock price increases, right? What they say is, in simple, what is the relationship between the call price and the stock price is, if the call price of the option in the market, the premium of the call price to be increasing, if it is increasing, the simple reason why the premium of a call buyer is been increasing, because the stock price is increasing in the market, right? That is right. It is vice versa in the case of like put option, right? If put option premium has been increasing because the because the spot price in the market has been reducing, right? So that is the reasons, right? If the market price is continuously rising and you wanted to buy a call option, then the premium at which you will buy the strike price would be very higher. So you have to pay a higher strike price and buy the call option, because the trend is very bullish. Fine. That is one thing. The stock price is very plays a very important role for calculating the Black-Scholes option. The second is exercise price. Exercise price is nothing but the price at which you have been entering in the contract, right? So what price that you have been entering into the contract is also important, right? What is the value of the call decreases when increase in the exercise price, right? If the strike price is more than the current market price, right? If the strike price is less than the current market price, then the stock is undervalued. If the stock is undervalued, then the premium is higher, right? When the excess price is greater than the current market price, what happened? The option contract is overvalued into the market. When it is overvalued in the market, then definitely there is a less demand in the market, and the premium would be very less, right? So this is the equation with case like stock price and excess price. What kind of a relationship that exists? Fine. So time to expiry, right? When you say time to expiry, longer the time, right? If you like 1 month, we have just started. Suppose you take now you take the May month contract, right? So May month contract which is going to get expired in the next 1 week, right? By the next Thursday it is going to expire. So it is very near to the date of expiry. When such contracts which are very near to the date of expiry, its premium get decreased because uncertainties are very less. Right, uncertainties are being reduced, its premium get decreased. Right, if you freshly buy June contract, suppose you want to buy today the June contract, right, which is going to have another 1 month contract, then the premium what you will be finding in the market would be the higher premium, right? So longer the time, higher would be the premium. Shorter the time, lesser would be the premium. Okay. Now comes the risk-free rate of interest, right? The risk-free rate goes up, the option values also goes up, right? So when you say the risk-free rate in the market is will increase, right? Then what happens? Call option prices will also go up because risk-free, that is the investment is very high, right? People are investing more into the market, the interest, the demand for the risk-free securities are increasing. Definitely people will also take up the risk of investing into the option market. That is the reason what happens, the demand for the option contract will also rise up into the market. Okay, that is the risk-free rate. Then the volatility, right? As the volatility goes up, the value of the option will also goes up, right? Lesser the volatility, lesser is the uncertainty, right? When you say uncertainty, more thing is certain, right? As a time to understand the time to expiry, right? So we have a 1 month time to expiry. There is a lot of uncertainty, lot of volatility into the price because another 30 days is there for expiry of the contract, right? So definitely what happens here, there is a lot of speculations. People will not be knowing what happened in the next 30 days. So hence the volatility will be high. When the volatility is high, the price will also high. As it comes very closer to the expiry date, what happens? The volatility will be less, right? So because uncertainty is very less, certainty is very more, then the premium will also be less. So these are the 5 variables are very common, are very important to know or to calculate the Black-Scholes model. Without these 5 variables, we may not be able to calculate the Black-Scholes model option pricing, right? One is the stock price, which is denoted by S naught. Then you have exercise price, which has been denoted by either K, capital K, or capital E, right? Either these two terminologies that we use it to calculate the option pricing. Either we can use capital K or capital E for exercise price. Time to expiry we always denote with the capital T, right? Then you have like risk-free rate, which is denoted by small r. Then you have volatility, which has been denoted by the symbolically the sigma's variable, right? Symbolically we represent by the symbol volatility. Okay. Now let's try to look at how exactly that we need to proceed for calculating the option price, right? The first thing, what is that we need to know? The first step based on the requirement, right? The first step is whether we need to know, are you interested or there is a requirement to calculate the call option or you need to calculate the put option, right? So the first thing is you should be very clear whether you want to calculate call or the put, right? When there is a call, the formula is different. When there is a put, the formula is different, right? So based on the given data, the next important thing is what is that you need to identify is, first you need to identify whether you need to calculate the call option or you need to calculate the put option, right? So once this clarity has been clear, whether we need to calculate the call option or we need to calculate the put option, next what is that you need to do is you need to thoroughly read the given data, the given question, and try to understand, right, what kind of a data it is having, whether the underlying asset is having no income, with income in the form of cash, with income in the form of dividend yield, right? That thing you need to make it clear, whether any dividend component has been given in the question, whether dividend component and all other variables are being given, all other 5 variables are being available, right? All other 5 variables plus the dividend component. When there is a no dividend component, so you will use a standard formula of calculating the Black-Scholes model. If there is a dividend, then you need to identify the dividend is in the form of cash or the dividend is in the form of dividend yield, right? So there are the 3 standard formulas that you come across in the Black-Scholes model. One is a standard formula that is no income. The other is a standard formula that is with the cash dividend. And the third is a dividend in the form of yield. These are the three formulas that you come across in terms of calculating the Black-Scholes model. Okay. Now let's go to the third step. Right. What is the third step? Right. The third step here is nothing but based on the given data. As I said, like first case is what? There is no dividend. Case 1. Case 2 is where there is a cash dividend, right? And the third case where there is a dividend in the form of yield, right? So you have a three cases: case 1, case 2, and the case 3. Case 1 in the form of no dividend, case 2 in the form of cash dividend, and the case 3 in the form of dividend in the form of dividend which has been mentioned in the form of yield. Okay, these are the three different cases. Let's try to understand what is the standard formula and how to proceed. This is very lengthy formula, right? And it is a lot of calculation is been involved. So we need thorough understanding and clear picture about how to go ahead with the Black-Scholes model. Okay, so let's try to understand the first case. In the first case, what happened, where we understood that, or we are assuming that the situation where the underlying asset is not paying any cash dividend, right? So when the company is not paying any cash dividend, what is the formula for a call and what is the formula for a put, right? So we will discuss both the formulas based on the given requirement, whether it is asking you to calculate both the call and the put. Are they asking only to calculate call option? Are they asking only to calculate a put option? Based on the requirement, the right formula has to be applied, substituted, and get the result, right? So now, what is the formula for calculating the call option when there is no dividend payment? Right? The formula is capital C. C stands for call price or nothing but call premium. So we don't use a term called call premium because it is not a right terminology in the option market. The right terminology in the option market is a call price. So we need to call the premium as a call price, right? Even in the case of call and the case of put, we had to use a term called price, right? So price of a call is nothing but the price of the premium. Sorry, price of the call nothing but the premium of the call or premium of the put. Okay, capital C stands for call price, which is equal to S naught, right? S naught stands for current stock price, right? So our current stock price are what we call as a spot price. Current market price, current spot price is not nothing but S naught, which is available for you in the market. If you wanted to buy and own the asset, that is where you have to pay the price, that is S naught, multiplied by capital N. N stand for normal distribution value of D1. Okay, so D1 is what we need to calculate from the formula. Okay, that is derived value that we need to calculate. Okay, so D1, that is capital N open the bracket D1. So it is a one variable ND1, simple what we call as a ND1 we call, that is S naught multiplied by ND1 minus capital K. As I said, capital K I can use, or I can use a capital E. So these are interchangeable. Some textbooks use capital K, some textbooks use capital E. So most of the foreign textbook, if you look at, they use K, and Indian textbook they use E. Nothing wrong in terms of anything. Only thing is when you write the formula, you need to indicate whether K stands for what. Okay. So K stands for here exercise price, nothing but the strike price of the asset, which has been available into the market, right? So you have different strike prices. Fine. Then capital K multiplied by small e. Small e stands for exponential value. Exponential to the power of minus R into T. Okay. Minus R is nothing but R stands for risk-free rate multiplied by T stands for number of days or number of months for expiry of the contract. Right? If it is a 1 month contract, 1 divided by 12. If it is a 3 month contract, 3 divided by 12. If it is a 6 months contract, 6 divided by 12. This is how the T will comes into the picture. R stands for risk-free rate of interest, right? So small e to the power of minus RT multiplied by N D2, right? Normal distribution value D2, right? So now I have been highlighted here ND1 and ND2. Why I have highlighted ND1 and ND2 are, this is where we need to apply the formula, right, and calculate the value of ND1, ND2. Rest S naught is been given, it would be given into the question. Excess price would be given into the question. Risk-free rate would be given in the question. Time to expiry of the contract would be given into the question. All other data has been given into the question. Only thing is we need to apply some mathematical model, that is Black-Scholes model, and try to know what is the value of ND1 and ND2. When you know the value of ND1 and ND2, substitute the values, you will get the call option price, that is C value. Okay. Now let's okay, before I go and try to know how to calculate ND1, I will discuss about put option also. If you want to calculate the put option price P, right? If you wanted to calculate put option price P, P equals to K. That is, first what happens in the case of put option, first exercise price comes, exercise price K, right? K R E, exercise price K, capital K, multiplied e to the power of minus RT, exponential to the power of minus RT, multiplied by N, that is normal distribution value. Here you have to take minus D2. Okay. In the case not just D2, you have to take minus value of the D2, that is N of minus D2 we call it, right? Overall minus sign, then S naught, that is the spot price, multiplied by N of minus D1, right? The same thing here, N of minus D2 and N of minus D1 need are, these are separate values to be calculated by using the formula of Black-Scholes model. The rest of the values which are being given in the question, that is K, that is excess price is given in the question, risk-free rate is given in the question, time to expiry is given into the question, and S naught is also given into the question. Only thing is, what is that we need to calculate? N of minus D2 and N of minus D1 to be calculated, right? Before I go to the case 2, first I will try to brief you about how to calculate ND1, ND2, N of minus D1, N of minus D2. Okay. Any problem till now? Any issues here?
No, sir.
No issues?
No, sir.
Fine. First, let's try to understand how to calculate this ND1 and ND2, right? We need to calculate ND1 and ND2. So we need to first calculate ND1 and ND2, that is normal distribution value of ND1 and ND2. First, we need to calculate what is the value of D1 and D2, right? So once we get a clarity about D1 and D2, then we proceed to ND1. So first, let's proceed to calculate D1, that is small d1 and small d2, right? That is for the first case. Situation is what? No income, right? No income. Just look at only the no income. Don't look at cash and the dividend yield method. That is no income. In the no income, what happens at D1? Right? Small d1 is equal to LAN. That is normal. What is a lag LN, normal distribution value, or a log normal distribution value, right? So that is either you can get from your scientific calculator if you have, or from the table value, right? So first, what is that we need to do here is LAN, that is LN, LAN for log natural distribution value. Open the bracket, S naught divided by K. S naught is nothing but the spot price which is available in the market divided by what is the excess price. First, we need to take spot price divided by excess price. What is the output you get? That output value you have to look at either from scientific calculator or from the table value of the log normal distribution value if you have to look at. So you will be getting the value of log value, log of S naught by K. Okay, this is the one variable plus, right? Open the bracket, R plus standard deviation square divided by 2 multiplied by T. Keep in mind that the multiplied by T is only for this variable, that is open the bracket R. R stands for risk-free rate. So what is the risk-free rate? That is nothing but treasury bill that has been prevailing into the market, plus standard deviation square, right? This is symbolically representing the standard deviation, nothing but volatility. So volatility is nothing but standard deviation, so which is represented here with the symbol standard deviation square. that whatever the standard deviation has been given, we need to square that. If directly the variance has been given, we don't have to square that variable, right? Standard deviation square divided by 2, right? After simplifying this, standard deviation square divided by 2 plus risk-free rate. When you simplify, then multiply with T. T stands for time to expiry of the contract. This is nothing but number of days, right? If we say the contract is for 1 month, 1 divided by 12, okay? This within the bracket, first simplify, then multiply with the T, right? So this is your right hand side component. Left hand side component is only ln open the bracket S naught divided by K, right? When these two values are simplified, left hand side value and the right hand side values, both the value get simplified, then divide it by standard deviation multiplied by, take the root of T, right? T value is nothing but time to expiry of the contract, right? Again, on the numerator side, what T we have been taken, the same T value, right? For which you have to take the square root first. Then once you take the square root of that, then you multiply that with the standard deviation, that is nothing but the volatility value, right? So once you simplify this, so you will be getting the D1 value. There would be always be some changes in the difference in the D1 value. The reason simple is we need to be very strict with respect to the digit, decimal after the digit, right? How many decimal after the digits that you have been taking. If all the student has a uniformity to take the values decimal after the number of digits, if you are taking 2 digit, 3 digit, 4 digit, right, you have to maintain the uniformity for rest of the all the equation, right? Only then you will be get the answer very nearest value. And also the answer will vary if you take, there is a small variation, not big variation, there will always be a small variation if the answer we have taken from the textbook, that is from the table value or from the calculator value, there is a small variation, minute variation would be there in the problem, right? So once you get the D1 value, then we need to calculate the D2 value, right? So D2 value, that in simple what we can do here is D2 is equal to D1, what we have calculated, minus the denominator value. The denominator value is nothing but standard deviation, open the bracket, square root of T, that is square root of T multiplied by the volatility, right? Will be giving you the D2 value, right? Once you get the D1 value and the D2 value, right? So I'm not discussing right now for the model case 2 and case 3, only I'm discussing about the case 1 to you, right? So once you get D1 value and the D2 value, right? So next go, okay. So once you calculate the value of D1 and D2, next we need to calculate the value of ND1 and ND2, right? So for which, as I said, you need to refer to the table which has been given to you, right? So I have already given to you the table, the scientific table value which has been forwarded to you. The same thing would be provided to you in the exam also. So normal distribution value. So what we have to do is, what is the D1 value you got it, right? So D1 value what you have been got it, for which what is that you have to do is, the D1 has to be look at from the table and try to know what is his normal curve value, what is the normal distribution value, right? So if you just look at here on my right hand side top, there is a bell shaped curve which has been shown to you, right? The on the left hand side there is a standard value what we call as a 0.5. Always any closing price you take, it will follow a normal distribution term, right? It will not follow the normal distribution wave. This is what the theory says, right? So all prices will follow a normal distribution value. First half is what we call as a standard value, right? It has been common to all the companies, which is standard value 0.5, right? Plus the table value which has been highlighted, right? In vertically I just highlighted few things, that is nothing but your table value, right? So now how much the price has been distributed, standard value plus normal value, standard value plus the table value is what we get the ND1 value, right? So table value, if we look at I just show you one of the example. Suppose the D1 value which I have been calculated in the previous slide. Here I have been calculated the D1 value. Similarly, I also calculated the D2 value, right? So when I take, I got, let's example, I got the D1 value as 0.37. So what I had to do is I had to split this 0.37 into 2, right? The first thing, what is the first value after decimal? After the first, that is in your primary class, you might have been studied units, tens, hundreds, right? So which value is in units, which value is in tens now? 0.37 if you take 0.37, right? Which value is in units, which value is in tens? Can you say me?
7 is units, sir. 3 is 10, sir.
No, ma. 3 is in units and 7 is in tens, right? So for decimal after first is in units, U, then tens, then hundreds. Okay, 0.37. Zero point 0.3 is in units, 0.07, right? Actually, if you take 0.07 plus 0.3, it would be 0.37. Okay, so 0.07 is in tens, 0.3 is in units. Fine. If you split D1, that is value is equal to 0.37, that is 0.3 plus 0.07. Okay, so first digit decimal after the first digit, that is 0.3, which is come, you have to look at vertically on your table, right? So if you can find the table value, initially I have shared you when the valuation is been doing, I have shared you the table value. If you have your mobile beside to you, or you can open and try to see the table, normal distribution table value. Okay, first 0.3 you have to look at vertically, which is represented as a heading Z, right? So vertically if you like 0.3, then you have to look at on horizontally 0.7, right? 0.0, 0.1, 0.2, 0.3, 0.4, 0.5, 0.6, 0.7, right? If you look at horizontally, so 0.7 to be identified. When you look at the table value 0.3 and 0.7, so you will get ND1 as 0.1443. Okay, that is the table value. This is what I have been shown you, right? ND1, if you want to know, standard value is 0.5 plus the table value 0.1443, right? The table value, which is going to give you the ND1 value, right? So once you get the ND1 value, substitute this ND1 in the main formula, which I shown you the first slide, right? Similarly, ND2 value has to be also taken the same manner, and substitute, you will get ND1 and ND2. Once you substitute the values ND1 and ND2 into this main formula, right? So you will be getting the price of a call option. Okay, this is what the lengthy process that you need to thoroughly understand. Similarly, to the put option, if you want to calculate the same thing, first what is that you need to calculate is, okay, so similarly for the put option, if you want to calculate, that is this is standard formula K, capital K, N, capital K, R, T, S naught is available in the question. What is that you need to calculate? N of minus D2 and N of minus D1, right? If you want to calculate minus D2 and minus D1, first you need to calculate what is D1 and D2. The same formula that we had to use it, right? After using the same formula, what I will be doing, what I'll be doing here is, when I take the plus and plus 5, sorry, 0.5 plus, I have a symbol right here. So there what I will do, I will be take that as a minus 0.5 minus 1.443, that I will be taking here, right? So that I'll be getting the value of minus D1, because D1 value is 0.1443, right? So when you say minus D1, I have to take minus 0.1443. That is 0.5 minus 0.1443 would be the N of minus D1. Similarly, N of minus D2 also the same case, right? So this is how I need to calculate the formula. I need to understand the formula first, then I need to proceed to the next. Okay, I put up the YouTube video of the same thing to you for better understanding. Go through this and try to understand once again thoroughly, right? In the next class, that is, we will start up the numerical, right? So possibly tomorrow, that is on Friday, I may schedule. Actually, I said you that I'll be scheduling the class yesterday, but there was a meeting with the principal office. It was a 4 hour long meeting, so I was not able to take the class to you, right? So that's the reason I'm sorry for yesterday's class. So if tomorrow conveniently I will inform to you and take up the problem of the Black-Scholes model. I will schedule the class tomorrow and I will engage the class, right? So meantime, if you may not able to understand once, go through the YouTube video of the same thing what I have been given the explanation. The YouTube available explanation is available in the YouTube. Go through it and thoroughly understand about it. Next class when you come, keep the table ready. Either the calculator, you should have a calculator, either scientific calculator or the normal calculator with the table which I have been posted you in the YouTube earlier, right? And also posted the question PDF question of you option valuation that I have been posted, right? So thoroughly understand and we'll start the problems on the valuation in the next class. Fine. So I will be stopping here the discussion.
Okay, sir.
Okay. Right. Thank you.